Hi, and welcome to this week's episode of the CostofCarry podcast. My name is James Chi. Let's get started. Continuing on from last week's podcast, I'll be going through another couple of examples and hypotheticals and adaptations that are again based on some of my clients' success stories, and as before, details have been omitted and changed in order to apply a more general and conceptual understanding of what happened. Scenario 1. Purchasing a small retail shop. Maria is a second-generation florist. She has been at the helm of her parents' business and for the last 2 years, and during that time, she has doubled the business's revenue and is strongly considering opening up another shop on the other side of town. Maria and her parents cannot afford to purchase outright and don't want to rent or lease a space. Maria approaches her broker at Ding Financial, who she heard about from a family friend previously who was in a similar situation when looking for a new office suite for their daughter's art school. Maria and her parents decide to meet the broker at the current shop to discuss what they are looking to accomplish. The broker establishes the parameters of the service as well as the type of product being sought. He believes that there are two possible ways to fund this expansion: borrow through a commercial SMSF or take out a new commercial loan against the new shop. After a couple of weeks of providing Maria and her parents with a handful of lenders and products that do both of these strategies, and after discussions with Maria's accountant and financial advisor, Maria decides to go down the route of the commercial SMSF option. The timing of this was ideal for her, as she had found a few shops and she was interested in, and she could settle on them in 8 weeks, which was possible under the SMSF option. Now, another thing to add about this is that Maria's parents, are not part of this commercial SMSF. They are merely transferring ownership of the business to Maria. And similarly, in Maria's SMSF, there are 4 parties: her husband, and her brother-in-law and sister-in-law. Now, those 3 other people aren't in the business, but then again, the SMSF is the borrowing entity. So once coordinating all of those signatures and guarantees and understandings, this is how the commercial SMSF loan takes place, which can be a little bit more complicated than a regular mortgage. And this was again explained when Maria was deciding which route to take. So, pros of this situation. 2 solutions were available for Maria's requirements and were able to provide comparisons and explanations of how each operate. The second benefit or achievement was that using the strength of the business and the security, which avoided bringing in her personal properties or her parents' properties to cross-collateralize the deal. So this was self-contained within the one product, which was fantastic. And also, the commercial SMSF alternative is a great way to, differentiate the lending portfolio. So say, for example, all your entities are levered up, well then maybe the SMSF is available, and like I said, it is a good alternative if it's appropriate. Now, the downside of this scenario is that there are a few more compliance requirements, such as creating a bare trust and statement of advice type documentation. And compare this to a regular commercial mortgage, this may entail a bit more of a price because of all the different professionals that you also have to go through. And also compared to a regular commercial mortgage, the regulation surrounding a property purchase under a company name or a partnership or even an individual name can be a lot simpler than a SMSF. And because of this, the advice and sign-offs requirement can also delay the process. But fortunately for Maria, everyone was on board and were able to do it within the 8 weeks. So in summary, Maria's situation could have been done without the commercial SMSF, and that's because as a broker, I'm not allowed to provide any type of advice in that regard. I can provide Maria with the options, as I did, to consider, but obviously she's the one who has to decide. She has to decide, and she may like to take into consideration what her parents want and what the SMSF members would like as well. And this can add, like I mentioned, complexity and compliance, because it's a different type of regulated lend. But overall, the same goal has been accomplished, whether that be under the standard commercial mortgage. And to her credit, it worked out very nicely. Scenario 2. Tax returns not prepared. William is the owner and head coach at his swim school in Adelaide. The business has been running profitably for the last 7 years, and he is looking to refinance his owner-occupied home so he can release some more equity in the home. Being someone who works and coaches over 14 hours a day, 7 days a week, usually between odd hours, the broker agrees. He agrees that he doesn't have enough time to look for the loan himself and decides to approach his broker at Ding Financial, who previously helped him get his home loan and his business premises loan in the first place. The broker agrees to meet William at his training centre, and they discuss a variety of topics such as issues with the current lender, amount being sought, purpose for the cash out, and documentation available for income servicing. When it comes to income servicing, William informs the broker that his current year's tax returns aren't ready for both himself individually and for the business, but he needs the money soon in order to get some new gym equipment and additional pool facilities to provide a better service for his elite athletes for the upcoming championship season. The broker notifies William that it is possible to get a loan under a low doc form of income verification, and that most lenders, will accept 6 months worth of business bank statements, given the only downside will be that it will be more expensive than a full documentation loan. After a week of discussion and workshopping, William agrees to pursue the low doc loan on his home and informs the broker that he needs the money within 4 weeks. At first, the broker was hesitant, as this was quite a narrow timeline, but he persevered and managed to structure the deal with 2 loan splits and streamline the process through an online loan application process as well as an online client fact find. Using online retrieval service for William's business bank statements and personal bank statements, he was able to show that William does in fact receive an income consistent with the amount stated on the low doc income verification form of declaring his self-employed income. And with this in mind, the application was submitted and settled within the 4 weeks, and William was able to get his money within his window of opportunity. And because of this, he believes that it will increase the profile and improve the clientele that comes through his training center. And with that in mind, he believes that he will recover the money within 8 months. So what are the pros of this situation? A low doc flexible option, which is exactly what William understood that he needed. He realized that given his time constraints, he wasn't able to wait for his tax returns, and given that his accountant had already previously told him that it takes a lot longer than 4 weeks to prepare his accounts, this wasn't really an option for him. He had to be a little bit more understanding and accommodating to the situation. And given that, although most lenders do prefer full doc, in quotation marks, full doc type of income verification with tax returns and tax portals and BAS and everything, the low doc option does limit the types of lenders that are available, but that doesn't mean that the lend is impossible, as we've just seen. Secondly, cash out for business purposes. Now, some lenders do have an issue with this, and this further reduces the acceptable lenders or available lenders, so to speak. More regulated lending, because we're in the home loan space, does require a personal or a use of cash out funds that benefit the individual borrower in a retail or consumer type of manner. So for example, whether that be to purchase a car, or perhaps do some minor renovations, or perhaps go on a holiday, things like that, or pay for schooling, pay off individual credit cards, things like that. And so the outcome of finding a home loan lender that can accommodate a business purpose is a real fantastic outcome, because it is a harder to find product. And thirdly, the benefit to William for drawing the money out of his home loan rather than doing it as a business loan against his commercial security was that he's able to take advantage of that residential rate. And that's not to say that perhaps structure-wise it's not as good, because obviously you want to be paying down your home loan as soon as possible. Now the reason why, as we've just seen, is that it made sense for William is because he was able to recover that money sooner rather than miss out on it or later. Now, whether this deal would have been done in the commercial space may have taken longer, but given that we were able to use an existing security, which was residential property, which is highly regarded with most lenders, is a great benefit or great outcome. And obviously the residential rate can be cheaper than the business rate in some instances. In this case it was. So yeah, like, not talking numbers, we can see that if there's, say, the residential rate is more attractive and less than the business rate, then if you're a business owner and you're worried about cash flow, then that's probably the best way to do it, or one of the ways to do it, sorry. So the best thing then to do, just going back to that, is to then speak to your accountant as to how to manage all of that, because we are doing one from the business into the home loan, so it just may require a little bit more attention. So what are the negatives? Well, because we're doing a low doc lend, the rate reflects the risk profile, and without without the concrete information that's, say, has been lodged to the ATO, this gives the lender the impression that perhaps you are a little bit more risky because your affairs aren't in order to begin with. But obviously, it was just in this case, it was more a matter of not being prepared at the time that it was needed. And that's what can catch a lot of people out, is that, if you are a small business owner, or you are a business owner or self-employed or whatever you may be, you need to be prepared for things to come out of the blue that will catch you off guard, and perhaps you need quick money and a quick reaction. And that can't be done in instances where a full assessment needs to take place. So having these alternative options and flexibility with the lender is a great benefit, I believe, to many self-employed borrowers. And the second negative would be that the types of lenders that were available were limited, not only due to the low doc but also due to the cash out. And this is because this type of lending can get a little bit risky for the bank in terms of how they structure certain deals internally. Now, in terms of what's available in the market, there are lenders available. It just becomes a matter of structuring and pitching this deal in the right way to the lender at the right time. And like I said, and as William found out, that's exactly what the broker is there for. So in summary, low doc or alt doc income verification can be done in three main ways. The first is business bank statements, the second is BAS statements, or BAS, and the third is an accountant's letter. William does have the flexibility in how he would like to do this, but since he doesn't want to see his accountant because he's already been told that it's not able to be done in that time, and given that he already has access to his own business bank statements, this option gives him a lot more flexibility, and it provides him with a solution when he needs it. The good thing about this loan is that if he wanted to do a business loan, he would have needed to provide full doc information such as tax portals and tax returns, management accounts, and clearly that what William wanted was something a little bit more, wanted a lender who could understand what he wanted to do and was more focused on solution. Now obviously there is a little bit of a caveat that's saying if we're going from a full doc to a low doc, we just have to explain a little bit why, I suppose. And that this is definitely possible, like with commentary and the like. And as such, if we're looking to, say, go from a full doc to a low doc, well, of course it may cost more, but as we've seen, there's a commercial reason for it. And that concludes this episode of the Cost of Carry podcast. Thank you all for tuning in, and I'll see you in the next episode.